You don't want recession to catch you off guard. So know what are the markers to pay attention to. While unemployment might affect you personally, but it is also one of the reliable indicators of the future recession. Mass layoffs in certain industries or increased unemployment may signify a recession. So here are some prominent red flags to watch out for. Before we move forward, please do consider subscribing to this channel if the subjects of business, management and economy are of interest to you. The true measure of size and health of country's economy is its GDP or gross domestic product. Essentially, it is total value of goods and services produced by a particular country or an economy over a specific period of time. An increasing GDP signals economic strength, while decreasing or negative GDP indicates economic weakness or decline. So watch out for GDP numbers to begin with. Same could be witnessed by watching and tracking industrial production trends, and that would be our second red flag to watch out for. Though this factor directly impacts GDP, falling industrial production numbers has to get the alarm bells ringing. Do let me know in comments as to what are the GDP numbers of your country in last 2 quarters. While GDP and industrial production numbers are easily available in newspapers and periodicals, the more investment-savvy individuals also look at following points. The yield curve, which shows if the bond investors prefer short-term or long-term debt. When this curve is inverted, it means the bond investors are looking at the long-term investments because of the market expectations in future ahead. Other easily available and visible elements that you can watch out for could be the stock market decline. While the stock market goes up and down on daily basis, but if certain indices like Nifty, BSE, S&P 500 or Dow Jones Industrial Average drops a lot, it means the investors are worried about the future of the market. Another interesting red flag worth watching is tightening credit markets. When there is not enough money to lend, it could mean recession is coming. It might be harder to get loans, or the interest rates might be too high for people to afford. Decreasing housing prices is another important element that you could watch out for. When home prices go down, it could be a sign that economy is getting worse. This often happens in places where people build too many houses, and it can also affect the credit market. I hope you would have subscribed to the channel by now. If not, then please do consider. While the above discussed markers could give you fairly good indications of where your economic environment is heading to. However, respective governments or financial institutions like International Monetary Fund or World Bank keep publishing data and report with indicators and trends of various economies. You may further choose to write to me for any queries or clarifications that you might have. My mail ID is mentioned in the description. Be inspired, keep building.